Welcome everyone to the Settle In live session. My name is Maria Sigalas, and I'm the Senior Program Officer for Financial Capabilities with the International Rescue Committee. We've partnered with Settle In to offer a two-part series on taxes in the U.S. Please remember, when commenting during this live session, not to share any personal or confidential information as we're public-facing. In today's session, we'll give an explanation on how to prepare for your yearly tax return, including who needs to file, what documents you should prepare, where to go to get your taxes completed, and how to avoid tax-related scams. Part 1 of this series gave a general overview of taxes, including different types of taxes, what taxes pay for, and how we pay taxes throughout the year, which can be accessed on the Settle In Facebook page. So let's review a bit from Part 1, starting with what are taxes? So taxes are money that's paid to the government to help pay for different government services and goods. Because of the different levels of the US government, you pay federal, state, and may even pay taxes to your city or local government. At a national level, taxes are monitored by the Internal Revenue Service, or the IRS, and on the state level by your state tax authority. So taxes are important in many ways. The first being that this money finances government programs and services, which most of us use day to day. These services are meant to support services that we all share together as a community. Paying your taxes is also considered part of people's civic duty in the US. It's required by law and meant to be seen as a direct contribution to your community. Not paying your taxes can have negative repercussions. To be eligible for certain benefits, like Social Security benefits at retirement, you also have to show you've paid taxes for a certain number of years to be eligible. Lastly, if you're completing certain immigration applications or status changes, they may ask to see records of your tax returns or show how you've paid taxes. To avoid any stops or pauses in that process, it's good to pay those taxes and have that record. To learn more about why taxes are important, types of taxes, and repercussions for not paying taxes, see Part 1 of this series on the Settle In Facebook page. Now we're going to talk about filing your tax return. Your tax return is documentation that you file with the IRS and local tax authorities showing all your income, expenses, and other relevant financial information from the last year. Your tax return calculates your tax liability, or how much you should have paid for taxes, and compares that to what you've paid throughout the year. This return determines whether you paid the right amount of taxes, overpaid, or owe money. Tax returns are completed between the end of January through mid-April every year. This year, they start accepting returns January 23rd. And the deadline for the IRS to receive your return is April 18th, 2023. Filing your return every year is important, as it will determine if you meet your tax responsibilities. If you didn't pay enough, you will need to pay additional money to tax authorities, or you may have overpaid and will get money back. If you're employed with a company, either part-time or full-time, typically taxes are taken out of your paycheck. If you're self-employed, it's important to pay taxes throughout the year and be as accurate as possible because you don't want to owe money and might get some money back. So who has to file a tax return? The IRS has requirements for who must file taxes every year. You're required to file your taxes if you have taxable income of $12,950 if you're single, or $25,900 if married and filing together. There's a higher income requirement if you're older than 65. Most income is taxable. The money you earn from work, from a business, self-employment, unemployment, and even money that you're paid in cash for performing services or selling goods is taxable. If you're working for a company located outside of the US, you also have to report this income for your tax return. Public benefits like SNAP or cash assistance, support from an organization like a resettlement agency, child support, and any gifts less than $10,000 are not taxable income. So you do not need to report this for taxes. If you have self-employment income, for example, you own a business, work a gig job like Uber or DoorDash, perform other services for payment, and earned more than $400, then you're required to report this income and pay taxes on it. This includes any income you get in cash, which you're also supposed to report and pay taxes on. Even if you're not required to complete your tax return this year, it may benefit you. The first benefit is you could get money back. You may have paid too much in taxes during the year and get a refund, or that money you're receiving back when you file your tax return. You'll avoid any interest and penalties by filing an accurate tax return on time and paying any tax you owe in the right way before the deadline. Even if you can't pay, you should file on time or request an extension to avoid owing more money. An accurate tax return can make it easier to apply for assistance with education expenses. If you are applying for student aid, the FAFSA financial aid form pulls your tax return information. Paying your taxes also builds your Social Security benefit. You need at least 40 credits, which is about 10 years of working on file to be able to claim full Social Security benefits when you're older. It'll also give you an accurate picture of your income. You can use it when applying for benefits, credits, or loans. If you file accurate tax returns, you may get a loan with a lower interest rate and better repayment terms. Generally, when you file an accurate tax return and pay your taxes on time, you'll have some peace of mind knowing that you're doing the right thing to follow the law. So we mentioned that by filing your tax return, you may get some money back. This is called a tax refund. This can happen if you paid more than you had to during the year, or because you're eligible for credits or deductions based on your situation. It's always nice to get some extra money back. A credit reduces the amount of taxes you owe based on specific factors. For example, the number of children you have or your income. On the next slide, we'll talk about a few common credits. Deductions are items you can subtract from your taxable income to lower the amount of taxes you owe. Some common examples for individuals include education expenses, like student loan interest, certain healthcare costs, and contributions to retirement accounts. Deductions are especially important for people that are self-employed or own a business, as there are a lot of business-related expenses you can include to reduce the amount you'll owe in taxes. We can't emphasize enough how important it is to track your business expenses throughout the year so you'll have an easy time claiming these deductions when filing your taxes. When completing your tax return, you'll generally file for both your federal and state taxes. Your tax preparer will ask you questions to help determine if you're eligible for any credits or reductions in your tax liability. If it looks like you paid too much, you may receive money back from the federal or state government. We'll give 3 examples of tax credits that some of you may be eligible for. There's the Earned Income Tax Credit, the Child Tax Credit, and the Child and Dependent Care Credit. The Earned Income Tax Credit, also known as the EITC, is a reduction in your taxes for low-income families. To be eligible, you must have earned income, meaning at least $1 from self-employment or employment. And you need to be under a certain income amount. Additionally, you must be considered a resident in the US according to the IRS, which means you're a citizen, have a green card, or have been living in the US for at least 181 days or 6 months. If you arrived after that, you are technically ineligible for this credit. The EITC ranges from $560 for a single person to up to $6,900 for families with 3 or more children. The IRS will determine if you're eligible for this credit and how much you receive based on your family situation. The child care tax credit is a reduction of taxes for low-income families with qualifying children. A qualifying child is a child 16 or younger who lives with you for at least half the year, and you're responsible for paying for their expenses. Like EITC, you need to be under a certain income level to qualify and be considered a resident by the IRS. The credit is about $2,000 per qualifying child. The Child Independent Care Credit is a reduction in your taxes for people with earned income that are spending money on care for a qualifying child or other dependent. There are a few main requirements to keep in mind for this credit. You must have earned income or income you've gotten from a job or self-employment. You have to have a dependent that meets the criteria and be paying for their care. Through this, you can get up to $3,000 for one dependent and up to $6,000 for 2 or more dependents, which you'll need to bring proof of. Like EITC, you need to be under a certain income level to qualify and be considered a resident by the IRS. There are a few other specific requirements for this credit, so what's most important is you bring any documentation you have on child or dependent care expenses with you when doing your tax filing. If you filed taxes in the last few years, you'll likely get less money back this year. The rules the last few years allowed for more credits and flexible eligibility because of COVID, and these rules have all returned to their normal situation. There are other credits that you may be eligible for, but that all depends on your location and individual situation. It's important to note that the credits you receive in any refund is likely not going to be the same each year. There are a few reasons for this. The first is that tax law changes. Almost every year there's an update to tax-related law, which may change what you're eligible for. A big example this year is the child tax credit. Last year, due to the American Rescue Act, the credit was a larger amount and included older children. But this year that law expired and the child tax credit went back to its usual requirements. How much you receive also depends on your income and your family situation. You may earn more money this year, or have a child, or start taking care of an elderly parent. You may get married or buy a home. All of these factors could affect how much you pay in taxes, as well as your eligibility for credits and other deductions of your tax liabilities. It is therefore important to not compare your refund amounts yearly or with each other, but to check to make sure all the information you provide for tax filing is complete and accurate. If you do end up getting a refund, that's great. We always say tax refund season is the perfect time to think about your goals, and this refund could be an important step towards those goals. Some ideas and what to do with your refund include developing an emergency savings fund to have in case someone in your family needs to stop working, emergency flights to visit family, or for necessary repairs. It's recommended to save up at least 3 months of your expenses in case any of these situations occur. You could put this money into savings for a future goal, like education or a home. If you want to learn more about types of accounts and financial products to help you grow your money, you can go to safeirc.org and watch our Grow Your Money video in English, Dari, or Pashto. Lastly, if you want help in figuring out what to do with your refund, you can always meet with a financial coach. We'll share how you can schedule a meeting with a financial coach at the end of this presentation. So tax filing might feel overwhelming, but there are so many resources out there to help you. First, there's the Volunteer Income Tax Assistance Program, which offers free tax preparation for families that make less than $60,000 a year. VITA can help you prepare your tax return in person or remote. The IRC has VITA programs in New York City, Elizabeth, New Jersey, Denver, Colorado, Dallas, Texas, Salt Lake City, Utah, Boise, Idaho, Phoenix, Arizona, and San Diego, California. To make an appointment at an IRC VITA program, you can go to rescue.org/VITA. There are VITA programs in most cities across the US, and you can find the closest one to you by going to irs.gov/free tax prep. If you'd like to file your taxes yourself with some support if you get stuck, you can also go to myfreetaxes.com. Lastly, if you have more complex tax questions, for example, you have multiple businesses or investments, you could go to a paid tax professional with an accountant or accounting businesses like H&R Block. A note on going to a paid tax preparer. There are some scammers out there or people that take advantage of taxpayers to get more money. These scam tax preparers try to get more money for themselves by requesting to be paid a percentage of your refund. And they'll often complete your return incorrectly, so the refund is larger. So just be aware if someone's asking that, it might be best to go see someone else. When you've decided how you'd like to complete your tax return, you'll want to prepare all your documents for the return filing. It's a good idea to have everything ready in one place so it's easy to find for tax season and easy for the person preparing your return. To complete your tax return, you'll need your Social Security cards or tax identification number for everybody that will be on your return, and photo identification or photo ID. You'll need your income and earnings documents. If you're an employee of a company, they'll provide you with a W-2 form in January, which includes all the taxes deducted from your paycheck throughout the year. If you receive Social Security income or unemployment income, you'll need to bring those documents as well. If you have self-employment income, you may get a 1099 from the company, or a 1099-K if you earn income online through places like Uber or Lyft. Or you can provide a receipt that you filed your taxes quarterly. You'll want to bring your documentation for any deductions you may have. For example, car expenses or mileage for a mileage deduction, which can include receipts, trackers you use, or if you use an app, bring that all with you for your appointment. If you worked any other jobs that didn't report, like cash jobs, you'll also want to come prepared with the total amount you earned. If you're filing for your spouse or your children and dependents, you're going to have to bring their documents with you too. Lastly, you want to have your bank account information so they could do direct deposit for any refunds you may receive. There may be other documents that you'll need to bring to verify the information on your return, which are state specific or on request for IRS. So we've seen instances, for example, where they've asked for birth certificates for children and things like that. So just be prepared that you may be asked for more documentation at a later date. Now that we've reviewed everything about taxes, including how to file your tax return, the last topic we want to talk about is tax scams. A scam is a fake inquiry or story to trick you to share your personal information or financial information so they can take your money. Scammers increase their activity during tax season, and they'll try to use tax preparation in their story to get your money. Scammers will usually call, text, or email you claiming they're the IRS, a tax preparer, or another official agency with a convincing story asking you to share your information. There are some ways for you to spot these scammers. First, the IRS will never call, text, or email you. They'll usually send communication via the mail. If you get a call claiming to be the IRS or an email telling you to click a link to get a refund, it's likely a scam. The IRS includes a list of common scams on their website, so you can check there to see if the communication is real. Scammers will also ask for your personal information, your social security number, bank account, or ask you to complete a financial transaction to share your information with them. If someone is asking this, then it's likely a way to try and steal your information. Scammers will also demand immediate payment. For example, they'll call and say, "Hi, this is the IRS, and you owe $500 for your tax return. What is your bank account number? And we'll fix this right away." This is a scam. The IRS won't call you and they won't ask you to pay immediately. Scammers may also promise some type of reward for sharing your information or clicking a link. For example, this person got an email saying your economic impact payment is available. Click here to claim your money today. We all love to get free money, but good news like that will likely not come from the IRS in an email. Lastly, another common tactic that we see with scams is they're threatening an immediate consequence if you don't act now. They say they'll alert the police or take your home. These calls can be pretty scary, but again, the IRS would not threaten immediate action against you in this manner. The police will not come after you for paying the incorrect amount of taxes. If scammers contact you, you can do a few things. First, ignore it. Read the information, then delete it. You can also block the number so they stop bothering you. Don't give out your social security number or bank account information without proof the person is who they say they are. If on the phone, you can ask them for their contact details, name and callback number, and say, "You're going to check on this," then hang up. You can take some time to research, check on the IRS website, even search the number to see if it's real. Likely, they won't want to give you this information. That's probably a clear sign that they're lying. If you get an email, don't click links or open anything. Check the email address. If it looks funny, like it has a lot of numbers and letters, or doesn't end in irs.gov, it's likely not the IRS. So you can just delete the email. You can also report the scammers to IRS and the Consumer Financial Protection Bureau as well, so they can update other taxpayers with these scams. When in doubt, do some research and see if it's a legitimate issue. You can call the IRS, you can check the website and investigate before sharing any of your personal information. So part 1 and 2 of our Understanding the U.S. Tax System is available online on the Settle In page. For more financial classes on topics such as this, or to discuss your individual financial situation and goals with a coach, find us at safeirc.org, where you can see our upcoming classes, watch a video, or contact us directly to schedule an appointment. I'd like to thank you for joining us for the Settle In Live event. We covered a lot of information. You can return to this recording after the event to review the information again. We also encourage you to follow the Settle In Facebook page for the latest information you need to know as you adjust to your life in the United States.